Hey, what's up guys? John here. Some really big news in the real estate market. For context, I'm under contract right now to purchase a property 2 blocks from the ocean in Florida. And I read this article today talking about what Fema is doing starting October 1st that's going to essentially just change the entire real estate market in most desirable locations in America, making property ownership very, very challenging for many and not affordable for most. Take a look at this article and you'll understand where this economy is going, especially with home ownership and property ownership. Phase out of insurance, flood insurance subsidies could upend coastal real estate markets. It's no secret that Americans are willing to pay a premium for property on the beach. They could soon be paying a hefty insurance premiums to live there as well. Starting October 1st, the federal government plans to start gradually reducing subsidies for its flood insurance programs, pushing up rates for homeowners, according to the New York Times. For the first time, the government will also take into account a home size, which means the owners of large beachfront properties are in for even larger hikes. Federal officials say the changes are meant to emphasize the true risk of homeowners face in flood-prone areas and to potentially encourage them to move to less vulnerable areas. Benjamin Keys, a professor of the University of Pennsylvania Wharton School, said that the slashing of subsidies is likely to impact residential development and home prices. Subsidized insurance has been critical for supporting coastal real estate markets, Keys said. It's going to require a major rethink about coastal living. The rate hikes will be phased in over several years. Hurricane and flood-prone Florida may see some of the most dramatic hikes. Insurance agent Jake Holhois said one of his Tampa area clients currently pays $480 per year for flood insurance. Her rate under the new system could soar as much as $7,147 per year. Now, when I read this, I talked to the realtor here and I said, if rates are going to increase $500, $600, $700 per month, that is a very, very big deal. That's a very big problem. And he's like, no, that's not really that big of a concern, just listening to him. But the reality is what $600 per month is, or $700 per month is about $130,000 worth of monthly debt, that monthly payment. So $130,000 borrowed over a 30-year fixed rate mortgage would probably equate to that same payment. So essentially, I'd be paying $130,000 more for that property based solely on the insurance premiums. Now, people are going to be taking this into consideration when they're buying their properties, how much more it's going to cost to insure these properties and keep their investments safe. That also considering that banks are going to require this insurance because they're going to want to make sure that their investment is going to be protected. Now, if their investment is not going to be protected, you're most likely not going to get the financing. And that's what leads me to this CNBC article that just came out where they said there are numerous stakeholders in housing finance, including consumers, landlords, home builders, appraisers, mortgage originators and servicers, insurance companies, mortgage investors, government agencies, and the government-sponsored enterprises that insure mortgages. Fannie and Freddie. That means climate change will send significant pressure down a long financial line. Not only is climate change putting more stress on the natural flood insurance program, it could also increase mortgage defaults and prepayment risk, trigger adverse selection in the types of homes that are being sold to GSE, increase the volatility of housing prices, and produce significant climate migration, according to the report. For instance, lenders who securitize their loans with the GSEs could face additional cost for representation and warranty insurance, which covers breach of contracts and warranties in large financial transactions and higher risk as the GSEs revise the requirements in response to climate change. Just a few weeks ago, we had the Redfin CEO come out and say this very thing. He said that the lack of ability to insure properties and the lack of available financing is going to push people outside of these markets. And essentially, these markets are only going to be for the rich, people that can self-insure their properties. When I say self-insure, what I mean is if you buy a property, you pay all cash, and you have a flood, you have a storm, you have an issue, you come out of pocket, you pay for that issue to be rendered and taken care of. Now we take a look at this overall area. This is FEMA. Everything in red and purple is going to be a danger zone. So all around Florida, even good pockets of Texas, California, even New Jersey, New York, Delaware, Tennessee, basically a lot of America is going to see big increases on their insurance costs. Not all, but a good chunk of Americans will. And what happens is some policies, some of the bigger firms are backed by FEMA. They're smaller private insurance companies that they pull their own rates and coverage. But essentially what's going to happen is if a majority of the market brings up their prices here and there's one small pocket of the market, all they have to do is simply come up a little bit more. What is that going to do? It's going to give buyers no other choice. Buyers of this insurance product, they're going to have to pay because the only other alternative is to pay even more. So what's ultimately going to happen is insurance costs are going to likely be going up through the roof October 1st. So we have this coupled with this very questionable economy, the eviction moratoriums, forbearances, and we have a lot of problems. We have a lot of problems coming very soon. And when they say they're going to phase this out over the next couple of years, what's likely going to happen is going to be, every year it's just going to increase. So you have a higher cost of living, you have inflation, you have a lot of problems coming on the horizon. And when we look at these desirable markets in California and Florida, it really makes me wonder how Miami and how these certain pockets are going to hold up over the coming couple of years. They go on to say, this is on FEMA's website, the risk rating 2.0 in action. FEMA is updating the National Flood Insurance Program, NFIP's risk rating methodology through the implementation of a new pricing methodology called Risk Rating 2.0. The methodology leverages industry's best practice and cutting-edge technology to enable FEMA to deliver rates that are actually sound equitable, easier to understand, and better reflect a property's flood risk. Even we saw just about a month and a half ago in Philadelphia, which rarely ever has any problems, the flood was so bad that you could be on I-95, and you could swim and almost touch the exit ramp sign, which is probably 22 to 25 feet off of the ground. That's how bad it was. So we're going to start seeing all these markets go through a big change in the affordability aspect of property ownership. What do you guys think about what's happening right now with the rising costs, and where do you see insurance costs going over the next 1 to 2 years, even 3 years, even this year? When we start to see these premiums go up, we might see a lot of homeowners say, you know what, I could barely afford the cost of living before this. Now this puts me over the edge. Or we could also have a lot of people say, you know what, this could be an opportunity for me to start allocating capital into distressed properties going forward. The investors and the property owners that over leverage themselves a little too much when things are really good over the last couple of years. Drop your comments below, smash that like button, subscribe here, consider subbing on my personal channel down below. Leave a link in the top comment. See you guys next video. YouTube Success Blueprint. If you've enjoyed this video and want to dive deeper into growing your YouTube channel and create passive income as a YouTuber, check out my YouTube Success Blueprint by clicking the link in the description below this video. One of the richest men in the world, Warren Buffett, once said, "Opportunities come infrequently. When it rains gold, put out a bucket, not a thimble." I get the feeling that many men and women today are using thimbles instead of buckets. The truth is that we're in a huge wave of opportunity. I'm not suggesting that the current situation hasn't caused any financial damage to people's lives, because it certainly has. You may be one of those who have been fired, transferred, demoted, or had his assets repossessed. When looking up my own channel statistics on Social Blade, you can see that I was able to grow from a mere 11,000 subscribers to 120,000 subscribers in just 15 months. You could do this too, and I want to show you how. My YouTube Success Blueprint is a complete A to Z guide that teaches you the necessary steps in order to get your channel up and running within a few days. YouTube is an explosive avenue where you can earn thousands of dollars based simply on uploading videos and monetizing them for views. Think of a bridge with a toll on it. That is a video that's monetized on YouTube. It also serves a great channel to capture leads, and potential new clients. Personally, I'm receiving roughly $30,000 per month in video views through Google AdSense just by people watching my videos on YouTube with 120,000 subscribers. This number is likely only going to grow as more and more people become accustomed to using YouTube. We have roughly 2.3 billion monthly users on YouTube, and I could see that number hit 3 billion in no time. To learn more about growing your YouTube channel and creating passive income as a YouTuber, register for my YouTube Success Blueprint by clicking the link in the description below this video.